Hello and happy Thursday. We've got jobs week kicking off here this week, plus Fed Chair Powell's testimony sparks a little volatility here again this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends that we're watching, and hopefully weed out a bit of the noise along the way. So again, this week is all about jobs. Now, that said, we have a little bit of data that we'll touch on today. But keep in mind, big number is tomorrow on Friday. But nonetheless, we'll cover what we've seen so far. And, very timely, of course, we've got Fed Chair Powell testifying this week, and that has certainly caused some market moving activity. So we'll kind of break that down a little bit as well. And lastly, a really good question of the week this week from Jeff about active versus passive management as far as investing. So we're going to talk a little bit about that and kind of our thoughts around the topic. So here we are right in the middle of jobs week. And let's start there, and then we'll talk about the Fed because that may warrant a little bit of a discussion. So on Wednesday, we had ADP employment report come out. That showed that we added 242,000 jobs. Now, remember, which was good, by the way. That's a higher number than expected. And I think, honestly, especially with the Fed Chair Powell testifying on Wednesday, the market, I don't think really reacted to this number in any way because this was a good number. I mean, I guess in a way, with the Fed sharing their thoughts, we saw quite a drop, but I think that was more around the Fed than the jobs number specifically, because I think a lot of the market is taking this with a bit of a grain of salt. For those who do listen to us, you may know our thoughts on the ADP employment report. I'll kind of share that again here in a minute. But basically, this is a measurement of jobs added each month. And it goes back for a long time. But basically, I think it was maybe summer or so of 2022, they stopped running this report to make it better. And really, since it has come back out, I think maybe late 2022 or so, it really has not been very telling. It's been very different than the number that we typically get on the Fridays of each month, which is the non-farm payrolls number. So again, take this with a little bit of a grain of salt. It certainly can be helpful to maybe get an idea, but really the number tomorrow is the one that's going to matter the most. On top of that, today we had initial jobless claims come out at 211,000, so actually up a little bit for this week. And I think many kind of expected this bump here this week, but maybe not quite that high. So, it's interesting to see that. We've got the ADP employment report showing a lot of jobs added last month. We've got initial jobless claims showing a higher number this week. So what that all shakes out to and how the Fed is interpreting that remains to be seen, but we're not too far away from the Fed decision here pretty soon. So with that, let's transition into Fed Chair Powell's testimony on Wednesday. Now let me start by sharing that, as always with these things, I mean, it was a political, I don't know, just political nonsense is maybe the best way I can put it. It was a lot of, senators from both sides really talking about, political issues and trying to tie that into the Fed's role. And, this is what we get as we get closer and closer to elections, and especially when there's somebody to point the finger at. So nonetheless, I do think the Fed maybe has not done the best job, but regardless, I don't know that the political theatrics tie into this too much. However, what was very clear in this testimony was that the Fed had stated time and time again that they plan to be aggressive. And again, this is nothing new, but it sent the markets in a bit of a spiral on Wednesday. He has been very clear about this. And I realized that the last meeting, maybe it was a little less certain, but nonetheless, he still said that they have a ways to go for raising rates. And, the market is so excited to see the Fed stop that they're speculating so much on every word. And at the end of the day, I do believe the Fed's going to continue to hike, as they say, because they are scared to kind of spook the markets one way or the other, really. So I think they're really going to communicate, very, very likely what they do in the coming months. So anyways, that did take the market for a bit of a dive, as the Fed again kind of shared that they plan to continue and be aggressive on their rate hikes. All right, before we get into our great question of the week, coming up next week, I want to touch on a couple of things. We have obviously the employment report tomorrow. We have CPI data and retail sales next week. And of course, all of this is just in time for the big Fed decision coming up the following. So we will be talking a lot about that next week. I mean, these are like, we got jobs, CPI, sales, those all factor into the Fed's decision. So that will be very timely, I think, in terms of some data points as we gear up for the next Fed decision there. All right, switching gears here a little bit before we get into that next week, I want to touch on our question of the week this week from Jeff, which again is about active versus passive management. And just maybe to recap a little bit for those who aren't as familiar, what this really refers to is this ongoing conversation, debate, battle, whatever, pick your term here, about active management. In other words, picking individual stocks, being more active in how those stocks are handled, versus passive, which is more of the Vanguard world, the index fund. You buy the index, you let it sit, don't do anything about it. Now, typically active may have more costs, and obviously there is more likelihood that you may underperform. Passive, on the other side of it, has lower costs typically, but no chance for over or really, I guess technically under by the fees, but really no chance for either, as long as the index is set up properly. Okay. Now, the key, I think, to this is now that we kind of have a framework of what these definitions are, is from our perspective, it's important to have both. I don't know why everything always has to be one way or the other, right? It's like politics are red or blue. Everything is black and white. Everything is active, passive. Like there is no in the middle for some reason these days. And I would suggest that the best answer to this question is some blend of the two. For our clients and the way that we help manage portfolios, we use a bit of both. We use a lot of passive investments where it makes sense, maybe where we can keep fees lower, where where there's very little likelihood for overperformance or risk management, right? If it's a very transparent market, generally that can be the case. Whereas active can still be really helpful in some areas of a diversified portfolio, and especially lately, right? So this all, when the markets are going up, this all sounds great. Active, passive, and especially the last 10, 15 years or so, passive side of the argument has certainly shown some signs of opportunity. But now, if you look objectively back at the last year and a half, 2 years or so, it's been a big shift to active. Active has done much better. And so I'm not saying one is right or wrong. I think that, again, in this world of black and white, there can be a gray. And I think that's what we're really trying to share here. That's the way we approach this. There is no right or wrong here. A little bit of both can be very strong, and if done properly, can not only create a very well-diversified portfolio, but really give you the opportunity for not just better performance possibilities, but more importantly, maybe is better risk management. Especially again, when we're seeing markets trading down, sideways, not just going up and up and up like it has happened the last 10 years or so. So I think that is extremely important. That's how we look at this. And again, the active versus passive side of it should be looked at not just in terms of the transparency in the markets, but where you're at, the time of the economic cycle, what sector you're looking at, what time we are in. Like there's all kinds of factors that need to be addressed there. And I think also, as far as you can use passive investments within a portfolio, but some hands on the wheels to say, okay, what can we look like, for instance, when interest rates were rising, having a passive investment that is owning bonds without any thought behind it, when we know rates are rising and bond prices were falling in 2022, can really hurt you. So you can still use passive investments, but maybe an active kind of overlaying strategy to help reduce those risks as well. So I hope that's helpful, Jeff. Great question and a very timely one, because it's funny how much the conversation has been around passive for the last 10 years, and now all of a sudden it is shifting pretty significantly. And again, I don't think either one is right. I think the right combination of the two is right. So I hope that's helpful. Let us know if you have any questions. We'll be sure to address them in our weekly updates from here. In the meantime, have a great upcoming weekend. We'll see you next Thursday at 3 to break down more jobs data, more inflation data, and kind of a glimpse ahead at the Fed coming up here pretty soon.